I'm sitting here with Genevieve of Grit Capital, here to talk about the fact we're almost at the end of the calendar year. We're about to start a whole new one, and the overall economy, the overall stock market has a bunch of question marks around it. What's going on with monetary policy? Are rates going up? Are they going to go rate up as much? I mean, we're recently hearing about finally, we already knew it was in the tech sector, but now in the finance sector, they're even laying people off. It seems like we might be heading into a rough time, and I am by no means a doomsday alarmist, but do you think they're right? Do you think they're overstating it? Do you think they're understating it? To the people listening right now, the sectors you're interested in and your optimism or pessimism, where are you at? Like the medium to longer term view.
Okay, so we'll take a step back I always play the long game and the short game. So long-term game, going to be in the stock market forever. Dollar cost average, good times, bad times. I'm not smart enough to know exactly when that's going to happen, right? So time in the market, not time in the market. Just basic finance 101 and investing 101. Short term, I mean, you got to be on the lookout because you've got to be tactical and strategic with your portfolio. So things don't look good. I'll be honest, they don't. The jobs market, it looks like a lot of the jobs that are being added right now, because we're still adding jobs, they're mostly in the lower income sectors, the services sector, but in the higher income sectors like manufacturing, those jobs are being lost. Tech jobs, as you point out, the financial sector, as you point out, those are places where people have higher discretionary income, can spend more, and that's generally better for the economy if those people have more money because they can buy more things. But that's not what we're seeing. These people are getting laid off. So I think you're going to start to see the unemployment rate go up. This is exactly what the Fed wants, though, because it's been too low for too long, according to them, too much money in the economy. And so if it starts to nudge up, which they think it will, and it looks like it will, they will start to not be so aggressive with the rate hikes. And we have another one coming up next week. We've had 5 75 basis point increases in a row. People are now saying it's probably going to be 50 basis points next week. If it is, we might get a short-term rally into the end of the year, what they call a Santa Claus rally. But it doesn't look good. Commodities are down huge across the board. Oil's down a lot. I think it's down $30 or $40 just in the last 6 months. That's generally not a good indicator. Copper, which is, the PhD in economics, is down huge too. So yeah, things don't look good in the short term, and I think you're going to start to see in Q1, Q2 earnings take a hit. And so, for me, tactically right now, I'm not putting risk on. I've taken quite a bit of risk off. I've actually sold all my crypto holdings in the last 30 days for 2 reasons. Number one, I wanted to lock in a tax loss. I was down on most of my holdings. But secondly, I was concerned. I hold a lot of my crypto in ETF in Canada that has a custodian that may or may not be in some trouble. So I want to speculate. I want to speculate on the industry, but I don't want to speculate as to whether my crypto is going to be available tomorrow. So I'm going to teach myself how to self-custody. So I'm going to be buying back my crypto after 30 days, but I'm not investing in any new private deals. I'm not really buying small caps or micro caps. I'm staying large cap, liquid, things that do well if the economy does well or doesn't. Like waste management is one of my big holdings. A lot of the financials, the banks, I've been adding to those. So it's just right now time to buy companies, good quality companies on the cheap. But I would never, ever recommend exiting the stock market by any means. This is a long-term game, and you got to be in it for the long run.
I like that. Now, I don't want to let the cat out of the bag, but for those of you who don't know, one of the largest financial substacks right here, make sure you're checking out. If we are looking at the year in review, can you explain some of the highlights and also lowlights of just your speculation, like where you got it really right, and then maybe one where, like, for whatever reason, the thesis fell apart?
Yeah, I mean, I think I went into 2022 with some level of optimism, like most of the industry did, because we came off such a high on 2021, so much money in the stock market, in the economy. I thought it was going to hold up for longer, but one thing we always have to remember about the stock market and investors, they look forward 12 to 18 months at all times. And so when the Fed is raising rates aggressively, what does that mean? Money's getting sucked out of the economy. It means everything's going to get more expensive. These companies borrowing is going to get more expensive, so they're not going to be able to do as much of it. Real estate across the board. By the way, real estate right now looks very scary. There's a lot of like funds that are looking like they're gating redemptions, like some like Blackstone, which have typically never done this, so that's a little bit scary. But yeah, I would just say that I didn't anticipate that the market would go down this fast, even though the data still looked good. The economic data this year still looked good. It's just that the market is looking forward, and you always have to remember that it's always going to move ahead of the data. So yeah, that's what I would say, God.
I very much appreciate that, and obviously thank you for your time, and here's to see what ends up playing out in 2023. Hopefully all of our portfolios are a little bit more green.
Absolutely.
I appreciate it. Thank you.
Thank you.